Hey everyone, it is Thursday and you and I both know what that means. That means we do our expert series and we bring back Jonathan Twombly. How you doing, sir?
I am really well, Michael. How are you?
I'm doing great. You know what? I got to tell you, I look forward to the week sometime in the future, probably 2021, where we don't talk unemployment claims first.
Yeah.
But we're not there yet, so let's talk about unemployment claims first. What'd you see this morning?
Yeah. So unemployment, slight dip, actually beat the expectations.
Mm-hmm.
And you know how the game works. If you beat the expectations, it's a win, and everybody talks about how great it is.
Yeah.
Except that we're still over 850,000 claims, which in any other reality would be, a signal to panic. Except it looks good compared to, million and a half claims or whatever it was,
Exactly.
like 6 months ago. There are two things that I think are of note with today's numbers. One is that they leave out California, which is big, right?
Wow.
They leave out California because California decided a week or two ago that it needed to shut down all new claims to get its computer systems up to speed for handling the incredible volume of unemployment claims.
Yeah.
So they bit the bullet, they shut everything down, and they're spending 2 weeks redoing their computer systems so that they can handle the volume.
Wow.
So without those claims from California, I didn't see any estimates about what it would be with California, just the acknowledgement that California wasn't included. But I think you could easily guess that California would be, 30 to 50,000 claims all by itself.
Yeah.
So take that 850 number with a caveat. The second caveat is we're still seeing this kind of bouncing around, give or take around the 850 to 870,000 band, right?
Yeah.
And that just continues to see, we're not seeing big rapid improvements anymore. We're not even seeing a trend. What we're seeing is noise around a certain plateau. And that is evidence to me that we've reached the point of the recovery where all the low-hanging fruit has been taken.
Yep.
And what we're seeing now is claims from companies that have gone belly up. So
wow.
That's how I read those numbers. And I think that, the official unemployment rate is still in the high 8s,
Sure.
Which looks better than double digits, but it is, just as I had said when this whole thing started, we may have a V-shaped recovery, but it's going to be a V-shaped recovery where the second leg doesn't reach the same height as the first leg. We're not going back to 3.5% unemployment where we were before.
No.
And anybody who is kind of, investing on the idea that, the momentum is there, we're going to be back where we were, in short order, I think really has to rethink. And if they're not rethinking that now, 6 months in, then I think they just have like a mental block around this issue where for some reason other than the data, they need it to be back where it was. And so they're just going to believe that it's so. But I don't think as an investor, you can't do it emotionally. You gotta be looking at the facts, and the facts right now are giving me pause about, where this market is, how sustainable it is, how this affects multifamily, et cetera.
Yeah. Well, first off, I want to give you a shout out and kudos because you were the first that I saw anywhere I'll call it a baseline, a floor, whatever you want to call it. You were calling that 4 or 5, maybe even 6 weeks ago, that 850 was kind of just the rate of decline was slowing, and you called it, pointed it out right away. So shout out to you.
It's not magic. There's no genius to this.
No,
it's just looking at the numbers, what do they tell you?
That's because you look all the time and you can make those decisions when you do it. You're not looking at one variable and pontificating, right? You see the trend, you make a call. That was awesome. That California data is interesting. I missed that. I did not see that in the reporting, but it makes total sense. California, I read 2 weeks ago, had a backlog of several 100,000 claims because apparently the throughput, it's a big chain, right? Lots of systems, all outdated, but there was one cog in the wheel that only could process, 1,000 claims a day. So if there was ever a day where more than 1,000 claims, the backlog just grew. Right. So they're trying to rip out that cog and put in a new cog to I don't know, split the demand or whatever the hell they're doing. But that's interesting.
Yeah, and then so look, when they're going to fix this problem and they're going to process that backlog, then we're going to see a huge spike, which is also going to be bad data, right? It's not going to be, you're not going to be able to make any conclusions about that, because, we may see a spike to over 1 million just for the week or two when they're processing those claims, and then it's going to come back, and whatever it comes back to is the real number after that. But I think, seeing a big spike, it's just, you got to look at now I like looking at the moving averages when I can see
continuous claims.
Right. So the continuous claims is one thing. That's how many people are still unemployed and still collecting. But the 4-week moving average of unemployment claims, that gets rid of some of that noisiness in the data. But if you have a huge spike, it's obviously going to affect it.
That's interesting. I didn't know about the California data. Because just this morning, right, I do that daily financial news show, and I always make it my first video of the day. And actually, it said in today's video that I think we're going to see 1 million unemployment claims sometime in October, right, for the week. And now I'm all but certain, because you're right. If they fix the flywheel, I mean, California could port 200,000 1 week, and it'll just be garbage data, to your point. But still, it will look bad. It will hurt the sitting president, because again, it'll be 1 million unemployment claims, and it's
Well, you'll see a whole bunch of short-termism on Wall Street too. When you see that, if there's a big spike, you'll see, and the thing that you'll see is there'll be kind of two kinds of investors who react to that news. There'll be the investors who look at that and go, "Oh my God, unemployment has spiked up again. Sell or buy," whatever their position is on it. And then you'll see the other people who are like, "Okay, I think this is what everybody else is going to do in reaction to this news, so I'm going to try to get ahead of them." And front run them. And so it has a, that's the way Wall Street is. You've always got all these people who are, you've got the people who don't know what they're doing, who are trading on emotion. And then you got the people who are trying to figure out how the people who trade on emotion are going to trade. And take advantage of that. And it just causes these,
high variations.
Yeah, exactly. And then, and I think a lot of what you're seeing on Wall Street still, is, it's been interesting. I hate to get off on this tangent, but I will anyway. So, there's been a lot of talk, is Wall Street overvalued? Is the stock market overvalued? Is the stock market not overvalued?
Sure.
And I was reading something interesting recently about how the averages are overvalued because they are so heavily weighted towards tech stocks.
Correct.
Which are very overvalued.
Correct.
But the rest of the stock market, when you take those out, is actually not overvalued. It's not doing very well.
No, true.
Because the data is reflecting the real. It seems like there's kind of a bifurcation. Tech investors are willing to pay enormous valuations for tech because they buy the Kool-Aid on the tech. Because it's
very
tech.
99.
And everybody else is if they're looking at the pipe manufacturing company, there's no hype about pipe, right? So they're looking at what does the business look like really? What are the prospects for this business? I'm not going to pay more than X for this because I need to build in a margin of safety when I buy, but the pipe manufacturers are not exciting to investors. The investors are very excited about, Apple or Tesla or whatever it is. And they get ahead of themselves there.
Yeah. There's going to be a rotation out of tech eventually. It'll probably come when the stay-at-home economy, we kind of get out of this, because that's all the money is going there, right? Can you imagine a better time for Amazon? I mean, really, we all got to stay home. Nobody wants to go to the mall. Christmas is coming. You get stuff 24 hours. I mean, it's like the perfect storm.
But I wonder if Amazon really is worth what it's. I don't think it is stocks myself. So I can at least sort of understand that story, but that's what it is. It's a story. People are saying, well, because of everybody staying home, it's everybody's buying an Amazon, and therefore I'm going to buy the stock because it's going to benefit. And but it's all just people telling themselves that story. It's not. It's not the actual fundamentals of this.
And then we have Wall Street analysts. If we want to talk about this, let's do it. Then you have analysts constantly raising their targets on no new information, right? They're just feeding this flywheel. And I've lived in this environment twice. In 99, there were companies that didn't make any money that just went up because of the story. And then we saw it in real estate with single family homes. Why did that go up that last 20%? Because everybody was talking about it. Everybody was buying it. Stupid money makes stupid decisions.
And the thing is, like, here's the thing, like, there are people who will make a lot of money off this, right?
Of course.
There always are. There are people who either are very smart and get in and get out, or they're very stupid and they're just lucky and they get in and they get out, right? And there are always people who will make money in these kinds of markets. Mm-hmm. And then they will always turn around and say, see, well, I made money on this. So therefore it's everything, you know, it wasn't a bubble, or I'm so smart, or whatever the case is. Yeah. But that, because those people, those are still just stories too. Mm-hmm. And because those people made money doesn't mean that you can make money by doing what they do, especially if you get in after you hear their story.
Exactly.
Right? Yes. Because the expectation that, well, you know, if it went up, you know, 50% this year, it's therefore going to go up 50% next year. That is not, that won't happen, you know, except in like really, really rare circumstances.
True.
But the chances are it won't happen. And I think we're seeing similar things happening in multifamily, like that same kind of story being told, which is the
fear of missing out is real.
Fear of missing out. It's the multifamily will always do well in a recession. You know, that sort of, you know, it's the only safe place to put your money now. It's better than the stock market. And I think you see that same sort of last 20%, you know, jumping in before the reality kicks in. And I think the reality is this 850,000 a week. New unemployment insurance claims, which are, you know, hitting the renter class disproportionately. You know, it's not hitting the homeowner class as much as it is hitting the renter class, because the renter class is by definition the more, you know,
hourly,
right? So now, that being said, I did see some statistics this past week that showed that you know, rent growth overall has really declined, right? But it is holding up better in the quote unquote renter by necessity category than the quote unquote lifestyle renter category. And I think that's probably reflecting the fact, you know, always reflects the fact that lifestyle renter, there's a lot, that's where the new product is. Right? So,
well, that they have the financial means to make a different choice.
Exactly. And they have that ability to, even if it's moving between apartment buildings, they can afford the cost of moving, right?
Exactly. They get a U-Haul or hire some friends. Yeah.
Yeah. I mean, or, you know, they'll pay somebody to do it. They're not doing it themselves. They can afford those costs. They can also now take advantage of the low interest rates to go buy something. So
exactly.
That's why you've got that problem with the renter, the lifestyle renter. But that being said, the most markets, even in the renter by necessity category, are down. Right. And what I think, and we all have been, as we've been saying for a very long time now, when those, you know, additional unemployment benefits run out, we are going to see some pain. And we're starting to see that now in the data where, you know, another thing that was in the data today was that income is down. Right. So unemployment, new claims were down a little bit, but more importantly, the more important issue is that income is down.
Yes.
Because, you know, income had been artificially inflated by two things. One was that they only track people who are working. So all the, you know, disproportionately all of the low end workers got taken out. Right. But then also there was all that, you know, free money being thrown around too, that boosted incomes. So incomes looked higher. Now they're declining. And that is going to hit the, you know, the pocketbooks of,
for sure,
of landlords, for sure. It's just inevitable. We've been kind of holding off on the inevitable, and here we are. And you're starting to see this in the, particularly in the lower end rental market, right? We're now, if you've been following the NMHC data all this time, it's been showing pretty strong collections at the A and B properties, the professionally managed properties. However, cracks are showing there too. We're off a little bit now for the latest data. I haven't seen the month end data yet for September, but as of 3 weeks or 4 weeks into the month, we're off by almost 2%.
Yeah, that's what I saw as well. Yeah,
which is a real, it's starting to, it's not a trend yet, but
it's a crack, to your word. Yeah,
right?
for sure.
But even more importantly, there are some signs of real distress amongst the smaller landlords who are disproportionately renting to the C-class renters.
Mm-hmm.
And there's quite a bit of distress in those areas. Some of it because people are gaming the system, some of it because the tenants don't have money
Mm-hmm.
to pay rent, and it's very difficult to figure out which is which. But there's certainly issues emerging with that.
Yeah,
as I would expect.
Yeah, I think there's a couple of things. Again, we've been talking about these for months. You have your own playlist on my channel. People can go back and look at it. We've been calling this for months. Class A tenants, right? The lifestyle tenants, we've been saying for quite a while, they have options. And also disproportionately, they're going to become owners in this cycle, I believe, because they can't, right? They've lived in an apartment long enough. Now they want their own backyard, all of that. But yeah, Class C, working class, lower end stuff, they're starting to feel the pain. And mom and pop, it's often called mom and pop investors, right? Single family. There's 11 million single family rentals classified in this category based on a Business Journal report or an interview I was in. And collections have not been great in that class. It's not reported a lot, right? They're talking somewhere in the high 70s, low 80s based on their data, right? Nationally speaking, which is not great, right? That's borderline insolvent at that point. Because again, right, the average profit is 9 cents if you believe some of the studies out there for owners. So collections at 80 is not great. What I've told them is mom and pop landlords are going to lose early, right? Some of them are going to lose their properties, and that's going to be very sad. Second, and what is likely going to happen longer term is tenants are going to lose. We are going to lose millions of affordable single family units in the next year, in my opinion. Because if you are a mom and pop investor and you've struggled, you don't like the CDC order, you don't like all of these things that, impacted contract law that's in the Constitution, you're going to be like, you know what? Here's a 60-day notice, Mr. or Mrs. Tenant. I would like you to vacate in 60 days. Most will, because that's, it's legal at this point. And they're going to clean up the house and they're going to sell them, right? So if we have 11 million single family homes, we could very easily have 9 million or 8.5 by this time next year. And that is going to hurt working class tenants, affordable housing. So what does that mean? Well, if supply goes down, rents are going to go up. You're going to be more rent burden. And it's just a vicious cycle. So what I told them is landlords hurt today, tenants hurt tomorrow. And I don't see how this gets fixed.
You know what's really interesting, and this has been related to this point, is that, for years in the multifamily world, there has been this idea that homeownership is disfavored and people only want to rent.
Yeah, sure.
And it's based on really bad interpretation of data because it's based on the idea, it's based on the trend, basically when the housing bubble burst and a lot of people who had no business owning homes were then foreclosed on, and the home ownership rate declined. And then it actually, everything always boomerangs, right? Like it's when the decline happens, it doesn't go back to the mean, right? It goes past it and then it rebounds. So basically people were looking at the data where, the long-term average for homeownership in America is 65%. It's been that way for
decades,
right? And then before the Great Recession, it went up to 70% because government was pushing people into home ownership and lenders were doing really dicey stuff to get people to take mortgages. And it went all the way up to 70%, and then the bubble burst, right? And so it went back down to 65 and cruised all the way down to 63. And people looked at that data and they just extrapolated the trend and said, you know what, like we're going to turn into renter nation and nobody's going to want to own a home, and that's great for multifamily and blah, blah, blah. Now, that is very short-term thinking. You should always think about reversion to the mean, right? And so what actually happened was it did decline to about 63%.
Yeah.
It's a little bit below the mean.
Yep.
And ever since then, it's been climbing back to the mean.
Sure.
And we actually had, if you look at the data from the Census Bureau, you actually see that the trough was in 2016, right?
Oh, interesting. Okay.
Just when people were like, and it was down at about 63%. And that was when this whole idea of like Renter Nation and everything really got
going.
Just really became like this frenzy, right? Nobody's ever going to want to own again. And millennials don't want to own.
Yes.
From that point on, it has been ticking upward steadily. There was a little blip kind of last year that went down a little bit. But what we see is since last year, so before COVID started, there was and this time probably times pretty well with the rise in interest rates from the Fed and then their decision to lower interest rates again.
Sure.
Starting last year, there's a dramatic increase in home ownership, right? And now what's happened this year is it's just exploded. Now, if you look at the census data, and this is what I'm looking at right now is the release from July 28th, 2020. So this is the most recent census release on home ownership that I could find. If you look at page, there's no page numbers on this, which is dumb. Okay, but anyway, figure 4, you can see the trend since 1997 for home ownership.
Okay.
And it has this year spiked from 65 to over 68%. Wow. And I find it a little hard to believe that we actually moved 3% in the last 6 months. I'm a little skeptical of that jump.
Sure.
But the trend is what you need to look at. And the trend is back towards home ownership. And the thing that's interesting about this data to me is that unlike in 2003, 4, 5, 6, 7, when lenders were pulling people from the bottom,
unqualified people,
right?
Yeah.
And the Bush administration's ownership society push was pushing, the idea being if people are homeowners, they become more conservative because they've got something to risk, they've got something to lose, right? So there was the home ownership push. There was, and the Democrats were pushing for other reasons, like for equity reasons. Everybody was pushing towards home ownership, but they were pulling from the kind of less qualified, right? But lending standards have improved since then. So I think what we're seeing now is a lot of qualified people who were sitting on the sidelines, who are now moving into home ownership, right?
Yeah.
So not the underqualified people, but able to, and now they're spurred by COVID and super low interest rates. Like the combination of those two factors has made them say, like, I'm going to own, and it's pushing into home ownership, and it's very, very interesting. So that's kind of like creaming off the best.
Yeah, the most qualified, exactly,
from the top, right?
Exactly,
and I think it's just I think that those two trends are probably meshing together, where a lot of rental stock is being pulled into home. It's being pulled off the market essentially, because it's going back to owner occupied.
Yeah,
and
this is one of the videos I did, I think it was last week. Is there so many people talking about a crash in 2021, which again I don't think is mathematically possible, but I said, guys, start thinking about 2025. And one of my things is I think homeownership goes up. And I think it's because of this. We're not taking from the bottom like last time. We are taking people who made lifestyle decisions that are now in their 30s, right? The millennials are in their 30s.
So
go ahead.
Yeah. I mean, so this is what I have been saying for years. And I think some of the better analysis out there has been on point here. There has been the simplistic model that says millennials don't want to own homes. And Grant Cardone, who we'll talk about in a minute, was out there pushing this really heavily. Grant Cardone was out there saying, like, millennials don't want to own homes, and they shouldn't own their own homes. They should rent, and they buy a rental house instead.
Exactly.
Don't live in don't own anything to live in. It's blah, blah, blah. There was this idea out there that millennials didn't want to own homes. That was just complete and utter BS. Yes. They wanted to own homes, but they wanted for the time being to live in like the high density cities where they couldn't afford to own homes, right? They wanted to go and like have fun, go out, live near, live near where they work, go out partying near where they live, like all that kind of stuff. They wanted the lifestyle, right?
Yes.
But we all knew, if you were thinking about this, that like everyone else, they were going to have kids.
Exactly.
They were going to pay down their student debt to a manageable level.
Exactly.
They were going to want to have more space, and they were going to switch into home ownership. That was going to happen, right?
Absolutely.
And so I think what we're seeing now is COVID has basically accelerated, has compressed,
collapsed
that trend, which you already saw starting in 2016 when in the trough
I'm telling you,
of the home ownership. So what's happened now is all those people who were planning this all along have all of a sudden like rushed into the home ownership market and are now buying homes and pushing
it's an investable trend, in my opinion, because not only do you have all of that, but you have record low interest rates, 30-year fix. You have their employers going work from anywhere.
Yeah.
It's just like, I really think Class A lifestyle product is going to be in as much pain as the working, as Class C stuff. I really do. And I think Class A might be in more pain because like Grant Cardone, he's out there saying on videos, and I've seen him, I will overpay for Class A properties. I'm like, ooh, that's going to hurt at some point. Because you're gonna have to lower your rents, I believe, in Class A product, at least some of them.
And again, that decision making process had to be based on the idea that millennials didn't want to own ever.
Ever is the key word,
right? That I can't think of any other reason why you would say I'm going to overpay now for Class A, unless your thinking is, the trend is in my favor and it's going to eventually make this a good deal, right?
Yep.
So, but another interesting wrinkle on this home ownership issue.
Sure.
Now, there's been a lot of talk about people moving out of the high density cities.
Sure.
Right. In New York City, something interesting is going on where people are leaving Manhattan, but where are they going? They're coming to the outer boroughs. They're not leaving the city, right? So the real estate market, from what I've been reading in Brooklyn, is very hot right now, and especially for anything with outdoor space. And
that's the key. I think you just said yes.
But it's not just that. I mean, people are moving out here because they just it's still more affordable, and they can get, it's less dense. They don't want to live in a high rise necessarily.
Space is good. Yep.
They want to live in either a smaller apartment building or buy a house or whatever. But what I found really interesting is that the way that listings are now being presented on Trulia, it used to be that the first thing that you saw when you scroll through Trulia was the front of the house.
Yeah, the facade.
Right?
Yep.
Or maybe you might see, like, if it had like a spectacular kitchen or something, you might see like lead with the kitchen, right?
Okay.
What you're seeing now is they lead with the backyard.
There's the patio.
Yeah, the patio is the first thing that you see. So, which is very
cool.
interesting. But I think, again, you have to always, you hear the stories in the press. The press always, especially if you're reading the non-professional press, if you're reading like the Yahoo Finance press or things like that, they're always just going to go for like the biggest, bluntest kind of data that makes the biggest impression and helps you understand how to invest the least. But usually that's like, people are fleeing New York. And then if you dig into it, it's like, well, yeah, some of them are, but a lot of them are actually just moving around within New York City to get more space, whatever the case is, or, so.
Yeah. And we're seeing the same thing in San Francisco, right? What we're seeing in San Francisco, again, the headlines are horrible, right? Listings up 100%. Price drops up 90%. I mean, just horrible numbers. But if you dig into it, houses, which there's a couple of areas in San Francisco that still have houses, still flying off the shelves. It's the high rises. It's the, 50-story condos. I mean, some of those are going to go bust because people, their listings are through the roof. So same stuff. So very cool. All right. You know what? Let's switch to Grant Cardone. You and I don't think have talked about Grant Cardone other than, bigger is better and, all of that stuff he's talked about, but he has had a couple of, I guess I'll call them lawsuits. Is that the right way to put it? A couple of filings. Is that
getting sued.
He's getting sued.
He's getting sued. And I mean, look, this is no surprise. Lawsuits happen when the economy goes bad. I'm saying this as a former litigator and somebody who has actually used to do, among other things, securities litigation. Lawsuits always spike in bad times because someone is, people are looking to get out of a bad decision, a bad investment decision they made, and they are going to go and pour through the filings to go and find an omission of fact, right? And or a misrepresentation of fact. And sure enough, and the bigger you are, the more you attract attention, and frankly, the more investors you have, the more chances you have of having a disgruntled investor who is happy to put their name on a class action suit, and and hope to get a settlement. So now, I'm not a big Grant Cardone fan, but on the other hand, that defense lawyer in me also just hates it when these vulture ambulance chasing lawyer types go after somebody and try to just extract the settlement out of them. So my who do I hate more is kind of like in conflict right now. But the short of it is, so Grant Cardone has been sued by some of his investors relating to a fund that he put together a couple of years ago, where the allegation is that he misrepresented facts in selling these funds to his investors, and they were included. The misrepresentations were included in his offering materials, and they include such things as, differences in value with properties he was contributing to the fund, and things like that. So I haven't really had a chance to dig into them very deeply yet, to decide whether, just on my own reading of them, whether they state a claim or not, meaning, whether they can be just dismissed summarily by a court because they don't actually
meet the bar,
make out a claim, that's the first step. If they make a claim, then they have to prove the claim. But the court's, the first step in the process is, does this even state a claim at all? So, and if they get past that hurdle, that's usually when, that's the first opportunity to settle, because you're like, okay, now we're going to have a trial, or at least have to enter discovery, and that's really expensive and unpleasant, and I don't want to be deposed. And that's usually when the first round of settlement talks happen. But in any event, I don't know if they really state a claim or not, but I do want to make a point here about doing syndications, raising funds, et cetera, which often gets missed in sort of syndication world. Now, in syndication world, we talk a lot about how to do your offering properly so that you fall within one of the exceptions to the default that you must do an IPO every time you sell a security. And I think a lot of people don't realize, A, that when you're doing a syndication, you're selling a security, your investors are buying a security, they're not buying an interest in real estate. Because they're buying a security, the default rule is that you must do an IPO. But IPOs are incredibly expensive. So the SEC created a number of exceptions for small IPO, for small offerings where it just makes no sense to do an IPO, right? That it would put these small companies out of business if they all had to do IPOs every time they raise money. So you can do what's called a private offering, but there are a whole bunch of rules that come with it: how you can sell it, who you can sell it to. And so there's a lot of talk all the time about how do we make sure that we're not, accidentally screwing up so that we don't, fall outside the exception that we're trying to fit in to this IPO rule, right? And then there's a whole kind of separate issue of who can raise money, and so the all of the air in the room is kind of sucked up by these two conversations. One, are we doing it right to fall within the exception? And two, are we raising money the right way so that we don't get in trouble? There's a third piece of this, which is almost never talked about, but it is very important. And it is that you can do the first two things correctly. You can fall within the exception. You can raise money the right way. However, you still have to avoid the possibility of committing securities fraud, which is probably even worse than messing up one of the other two.
Okay.
So your documents have to be buttoned up really tight to make sure that you are not misrepresenting any facts or leaving things out that are material that would affect an investor's decision. If you mess up either one of those two, even if you get the first two things right, you can be in a serious world of hurt. And this is often overlooked. And that's the allegation against Grant Cardone right now. Not that he messed up, not that he didn't do the Reg A offering properly, not that he raised money the wrong way, but that what was contained in his offering materials was a misrepresentation of fact. And that is the kind of thing that's where like the big punitive damage awards are available, right? That's where you can get, if it's bad enough, that's where you can go to prison, like Martha Stewart did. I don't know if you guys remember, like Martha Stewart went to prison. It was because of securities fraud, right? So misrepresenting an offering of securities that she signed off on, right? So it's, and she got sued. I actually worked as her defense lawyer on one of those cases that she was involved. So funny aside, one day I was like working, I'm in my office, I'm literally working on an appellate brief for her. And somebody says, my office door is open and somebody says, "Would you like a donut?" And I look up and Martha Stewart is standing in my office door with a box of donuts. Right?
Oh, that's nice.
And I'm like, I had just eaten lunch. I wasn't hungry, but like, who's going to turn down a donut from Martha Stewart, right? So of course I asked her, "Did you make them?" she's like, "Oh no, like they're from some fancy donut place in New York City." So it's like, "Oh, sure, I'd love a donut, Martha."
Thank you,
thanks
Martha.
very much.
That's funny.
So I didn't even know she was in the office, but
that's awesome. Did you? I guess back in the day, you didn't have smartphones when that was going on, so you didn't get a selfie or a picture with.
Yeah, exactly. You couldn't do that. You couldn't like post it to Instagram anyway, like me and Martha eating donuts together. So
that's hilarious. But let's get back to securities fraud, because again, when I hear you talk as a former litigator, I guess. Let's just say I'm not a legal scholar. I don't pass anything. I'm just an economics major who makes business decisions every day. I'm looking at these two class action suits. What you just talked about, securities fraud, gave Martha Stewart example, which I read about while I was going on. And all I could see is best case for Grant or Cardone Capital specifically is he has some big legal fees coming. I mean, that's the best case.
Yeah. I mean, he's going to have to, they're going to have to brief this motion to dismiss.
Yeah.
Right. I mean, so the first thing is when you get a claim filed against you, you have to. Usually, frankly, the first thing that you do is ask for more time. Right. That's always like the very first thing that
delay.
The defense lawyers will say. Is just like you have usually 10 days to respond. You file a motion, says give us 30 days. The court always grants the motion because it's just
right thing to do. Yep.
Yeah. And it doesn't hurt anybody to delay by 30 days and whatever.
Okay.
So that's like the first thing. Then you have to answer the complaint or file a motion to dismiss. And the motion to dismiss will basically say, assuming everything in this complaint is true, we're going to assume that it's all true. Even if it is true, there's nothing wrong.
There's nothing here. There's no smoke. There's no fire. Okay.
Right. So they have failed to state a claim of action, but that's going to cost, like
something.
He's probably going to hire a big law firm, that has a lot of expertise in securities law. That's a, $50,000 to $100,000 proposition right there, just to write that motion, just to go through the motion to dismiss, proceeding.
Right. And he has, and just so I'm clear, I want to make sure, because he has, I thought I saw two different suits. So does he have to do this for each one, or does one?
He does. Although they may, if the allegations are similar enough, they may try to move to consolidate them.
Okay.
But probably, I think before that, they try to get rid of them. So if they
kick them out,
so they may have to do, two motions to dismiss.
Okay.
And and if there's a barrage of suits, they might just then say to the court, like, hey, we're going to file a motion to consolidate. We're going to get all these, cases in one.
Right.
court with one judge.
Makes
So
sense.
we have consistent justice, and we can just deal with all the claims
Mm-hmm.
at once. And then what happens is you have a big fight with all of the plaintiff's lawyers want to be the lead lawyer, and they all want to, so they'll have a big fight amongst themselves as to like who gets to be the lead.
Yeah.
But that's the process. So, and these things often attract copycats, right? So,
Sure.
so what'll happen is when someone sees in the press, Grant Cardone is being sued for this, some smart plaintiff's lawyer will look at it and read the complaint and say, I think there's something here. I'm going to file my own suit. So you can get, I've seen it, a couple hundred cases filed against you if you're big enough, right? So it's because everybody wants their piece of you, right? So you have to be very, very careful. And now obviously you're not going to get hundreds of suits if you do a syndication with 20 investors, right? And but you just have to be concerned about this issue of securities fraud and just the way things work. If everything's going well, no one's going to sue you, right? But if things start going badly because maybe you overpaid for the thing, overpaying is not there's nothing, overpaying is not, it's not criminal. Actionable. It's not criminal. It's not, there's no civil liability for messing up, right?
Yeah, for stupid. If you overpay, that's not a crime.
Yeah. Nobody can win against you for making a bad decision.
Correct.
Right. But they can still sue you.
Yes.
And they'll try to find after the fact the misrepresentation that you supposedly made. And then you've got to litigate it. So this is like something that you have to be concerned about as a syndicator, because you are in some way kind of playing with matches. Maybe you're not playing with fire quite yet, but you are kind of playing with matches. Oh,
you got matches.
And you got to make sure that your papers are really buttoned up. And this is why I always tell people, like, if you're doing your first syndication, like, you got to hire a real syndication lawyer, because you can't hire somebody who tells you, oh yeah, I can do this. You got to hire the people who've done it, 20, 30, 40 times before to make sure that they really are doing your papers correctly. And that, the room for error is small. Doesn't mean you won't get sued. You can still get sued, but at least you're going to win.
Mm-hmm.
You may go through a lot of pain and expense.
Yeah. So there's a couple of things I'm taking for this. One is, again, as a former litigator in securities area, where there's a couple, there could be more suits. So we should probably expect headlines. It wouldn't be unreasonable to expect more suits, is a fair thing to say. Okay. Wow. That sounds expensive. Second, he's going to have to spend hundreds of thousands of dollars trying to get rid of these suits. Even if he wins, he has expense.
Yep.
Okay. If he can't do that, then it gets expensive, right? Then it gets really expensive. You try to, what do you call it? You try to agree on a settlement. The first answer is if you hit the bar, you try to settle. That's, you're from hundreds of thousands to millions, perhaps. And this could go on. How long was Martha Stewart's case? It was months, right?
Oh, these things take years.
Yeah, years. Okay.
Because when I got into it, I was working just on the appeals.
Okay.
And that was from the civil litigation. I wasn't involved in the criminal litigation, but it was the same law firm that handled the criminal litigation. And, but yeah, when you're talking about the, in a civil case, like in a criminal case, if you get acquitted, the state can't appeal.
Yeah, right? Can't go after you again.
It's over.
Yeah,
right? You can appeal if you. Yeah, exactly. You can appeal if you get convicted. You can appeal.
Yep.
Right, but it doesn't work the other way around. If you win, you're out.
Done. Yeah.
In a civil litigation, though, that's not the way it works. If you win, now in theory, right? What'll happen is most likely the court. Okay, well, this Grant Cardone may win the motion to dismiss, but then it depends on whether the court says there's two options, right? You can win the motion to dismiss, but the court can say, okay, plaintiff, go and fix your complaint.
Right, exactly. You missed that one, but look over here.
But not just that. It's just like, I think there may be a claim here. You just haven't stated it yet. But if it's so egregious, the court can say dismiss with prejudice. So you can't restate your claim, but you can appeal, right?
Oh, jeez.
So you can keep this going for a while, right? If you, even if Grant Cardone wins the first round, it's not over.
Wow.
So that's why the incentive to settle is there. And you might even still settle, even if you win the first round. You just have a better bargaining position now.
Right. Lower number.
To say, yeah, right, I'm going to pay you to just go away. But that doesn't deal with the other suits, right? Unless you consolidate them.
Right.
Or you may want to actually get a class certified against you, because then it'll cover everybody's claims and it binds everybody in the class. So all the investors in that group, who, even the ones who didn't sue you, it'll prevent them from suing you later.
Wow.
On this particular claim. So,
wow. So this
is not happy times for Grant Cardone.
And it doesn't sound like it'll be happy times for years, right? This isn't going to be behind him in 2020.
Yeah, this will go on for
years.
Months at the least, in the best case scenario.
The other thing I would love to talk to you about is, with the little bit I've read, and they've been 2 or 3 articles and summaries, is this is all around Reg A, right? Which my simplistic understanding is you can bring it to smaller investors.
Yeah.
Right. I think he went down to $5,000 was his minimum, if I'm correct from past videos. It's funny that I did a video, I think 6 or 9 months ago, saying, I think this is going to bite Grant in the ass, because what happens when you get lots of people, right? Instead, like your example, right? When you have 20 investors, right, in something, you've got 20 possibilities for suit. But if you go to a class A and you have thousands of people are going to have bad days, which what we're having, right? The tide went out. People are looking for money, and Grant's a flashy guy with a plane and Rolls Royces. He is a freaking target.
There's a lot to unpack in this, but I think, I was actually the other day when I learned about the suit trying to figure out, like, what Grant Cardone is really big. He can get institutional money, right?
Oh yeah.
Why is he doing a Reg A? And the only thing I could think of is he's looking for dumber money, right? He's looking for, or he's looking for people with less leverage, right? Because when you get into the institutional capital, then like the institutional capital, they're restructuring your deal. They're like putting in all kinds of strings to protect themselves.
Yeah, of course.
The money can sometimes be cheaper because their return expectations are more realistic, but the strings attached are onerous, and they can structure things to take the deal away from you if you do
exactly.
So he's probably wanting to go after this big pool of smaller investors because they have no leverage, right? But and he's an excellent marketer.
Oh,
right?
No question.
He's a phenomenal marketer, and he has attracted a huge audience.
Millions of followers. Yep.
Yeah. And so he's able to raise money easily from those people who are kind of starstruck by him.
Yeah. They want to say, I invest with Grant Cardone.
Exactly. Yeah.
Here's $5,000.
He's created this whole ecosystem where he's got fans who want to be able to brag. Like,
I invest with you. Yeah.
Yeah. I'm in a Grant Cardone deal. Now, the downside to this, though, is that, when you're doing syndication deals where it's, your minimum is 50,000, 100,000, whatever it is, you're dealing with a class of people who no one's investing their last 100,000 with you.
No,
right?
Exactly. Yeah.
Like usually what I'm hearing from people is like, I'll give you a shot at 50 this time, and then the next time maybe we'll do more, right? Because they have a lot.
They're willing to write that off.
Right. Because they know that this is something that they are risking, right? And if you've got also, you're dealing with people one-to-one on a personal basis.
Yeah.
Right? There's a lot of evidence from, like, say, the medical malpractice world about who gets sued. You know who gets sued? Doctors who are jerks get sued. Doctors who have good bedside manner don't get sued, because people, even if they make a mistake, people are like, you're a person. I have to get a relationship with this person. Like, it's a real person. People make mistakes, but they're willing to forgive you if they know you, and they can attribute it to just to made a mistake. If you're some distant guy who, by definition, you have to market like real rah-rah, pump you up when you're marketing to a big impersonal audience to get them over that trust hurdle. You're basically creating this potential issue for yourself of not only have you got a lot more people to potentially sue you, none of them actually knows you personally, right? And you're probably talking about the guy who like the $5,000 really means a lot to him.
Yeah.
Right? It's not like throwaway money that they've got, it's like the guy who it's going to hurt if you lose that 5,000.
Yeah. And again, back to Warren Buffett's, right? We know who's swimming naked when the tide goes out. That person with $5,000, it probably was, let's hope it's only 50% of his liquidity, but it could have been 100%. And now he just lost his job.
Exactly.
And he's like, shit, I need my $5,000 back.
Yeah. And and not just that, but it's like the temptation when the plaintiff's lawyer comes along,
yeah,
saying like, hey, you can get punitive damages here. As the lead plaintiff, you also are entitled to like a little bit of extra because of your time, right? Yep. So it's, and frankly, I wouldn't be surprised if because I know that this happens. Some of these smart plaintiffs lawyers will, go and have a friend invest in these offerings just in case, like later on.
Yeah. Hey, go put $5,000 in. It's just like a lotto ticket, right?
Yeah. Cause exactly. It's sort of like, hey, if it makes money, great. Like you're up,
you win.
And if it loses money, we'll sue. We'll do a class action and you'll be the lead plaintiff. Right.
Oh my God, lawyers.
Yeah. And that's why I'm not a lawyer anymore. I hate that crap. So, but it's just, you're
heads you wins, tails you win. That's
you're
good.
Putting a target on your back.
Yeah.
If you do, and this happens, and I've seen it.
Yeah.
Saw this happen. I was most active during the .com boom and afterwards, right?
Yeah.
And this is what you saw. There's a big frenzy around investing in stock.
I remember.
It was going to go up forever.
Yeah.
.coms were great, and then it all imploded. And guess what happened? All of a sudden, when beforehand, everyone's going, hey, there's no there. There's, these companies not actually making any money. And the investors like, yeah, but someday they will. And it's all going up and we're going to make a lot of money. And guess what happened? After it all crashed, they're like, hey, that company never made any money. We're going to sue them. They misrepresented, blah, blah, blah. And it's like,
So I think it's a shame. I think, again, I'm only going back to hit Grant Cardone's marketing, right? The whole helping out the little guy, which is what his marketing was when he initiated this Reg A, and he celebrated, oh God, it's expensive and I did it for you and all of that. It could be his unraveling is.
Well, I mean, listen, I don't think it's going to be on his unraveling because this is just one $50 million fund, right? So he's probably
it's only got that fund. Okay.
Yeah, he's not, I don't think he's being sued personally. And even if he were, I think it's very difficult to bring suit against him personally.
It's okay. All right. Yeah, so he has downside coverage. Sorry. The worst case
yeah, he should.
Okay.
Yeah, he should have some kind of protection. And I'm sure he's got insurance, that will cover his legal costs and stuff like that too.
Oh, nice. Okay.
Nevertheless, it's just, this is a huge distraction and it's bad for business. And if, that it might not be his unraveling, but then he's going to go through the rest of his life as like the guy who got sued for securities fraud.
Right. Would that potentially make his debt more expensive when he refied it, even if it's,
I don't know about that, but I think it'll make it more difficult to do future offerings. For sure.
Future offerings. Yeah.
Yeah.
Very cool.
And it'll have ramifications with the SEC, especially if he wants to do Reg A, the Reg A's have to be approved by the SEC because they're basically like sort of IPO light, right? So the SEC has to sign off. And if he winds up with a big settlement against him for securities fraud, the SEC is going to look at that. And
I think he's already decided. Again, I thought I saw this somewhere that he's not. I think he said somewhere that was his last fund, Reg A fund or whatever it was called. Yeah. I don't think he'll do another one. It's just not worth it for him. I don't think. Yeah,
I frankly, like I said, I was surprised he would do one. Right. But maybe he just was thinking like, I have this huge audience. How can I monetize them?
Well, he was probably getting phone calls and emails up the wazoo saying, "Hey, can I give you my money?" Right?
Yeah. Yeah.
And for a long time he had to say no. And it's like, well, screw it. Let's go say yes.
Yeah.
Yeah. It's going to be interesting to watch this unravel. But that's good news that I didn't realize that. Well, actually, let me ask this, because I heard two things from you. One is it's about this fund. So the worst case is that fund has losses or whatever. But earlier you used the Martha Stewart example where you could end up in jail. So I guess I'm confused.
Well, yeah, I mean, you could. So I guess if you really did create some kind of fraud on the market or whatever.
Okay, so that would be like the worst case.
Actually, maybe in Martha Stewart's case, that was insider trading. That was what
I think that's
what it was. Insider trading. Yeah, it wasn't secure. It wasn't like an offering fraud.
Yeah,
it was insider trading. That's what it was.
That's fair. That's different.
Yeah, but yeah, I mean, you could. They would have to allege that somehow he did something like personally outside the fund, like to get essentially piercing the corporate veil to get him personally.
Him. Okay. So what you're saying is, again, you haven't read it, you have no details, you're not involved, but with the little information you have today, Grant in jail is highly unlikely.
Oh yeah, I don't. It'd have to be really egregious, right? For that, I mean, and it won't happen from this suit anyway. The SEC would have to come in and file a criminal case against him for that to happen.
Oh, because this is civil, not criminal.
This is a civil case, yeah. So this is not
no jail time.
Yeah, no, this is not. I was just talking about the bad example of like if you do things really badly.
Yeah. I was just trying to make the connection.
Yeah, no, there's no. I mean, he's not looking at. This is garden variety securities fraud. Right. So, misrepresentations and omissions, from your paperwork. It's not.
So it's a civil suit for securities fraud.
Yes.
Got it. No jail time, at least currently.
No jail time. The issue for people becomes, now this is where the potential criminal liability can come in.
Mm-hmm.
This is like, this has been controversial for a long time, but it's been on the books for, decades. Wire fraud. Right? Because if you committed civil securities fraud, but you used the wires, i.e. the telephone, or now the internet, to do it, then that civil violation can then become the predicate for a criminal case.
Interesting.
For wire fraud. So it doesn't happen very often. But if the government decides you've really done something that they really don't like, that's how they would get you, because you can't make an offering without picking up the phone.
No,
right?
exactly.
So,
yeah. Cool. Oh man, this is going to be fun to unravel. I'm assuming. So again, I think what happens is more suits, copycats, I think was the term used earlier. No. He's going to have some expenses, even if he wins, probably has reputation risk as well. I'm going to say that he'll never do a Reg A again. It's just not worth it. But yeah, it's going to be fun to watch, and other people raising money need to pay attention because bad economies that people come knocking.
There is Grant Cardone will have to make the decision about whether to settle this or whether to fight it, because if he's concerned about the reputational risk or about the issue with doing offerings in the future with the SEC, he may want to try to fight it to a trial. To get
it came out, I'm the winner, I'm acquitted. Nothing here, folks.
Yeah, because even in a settlement, the settlement will likely say like, well, actually, I don't know if in a civil settlement you can actually do that. I'm not even sure if you can, like with a criminal case where you can like not admit liability or whatever. Maybe you can. I'm getting hazy on all this, but no still, or the settlements are confidential, right? Sure. But just the fact that you had one could be an issue with the SEC. So he may find himself in a situation where he has to fight it in a trial to get and go for an acquittal. And
sounds expensive.
Which is also dicey and very expensive. Very expensive.
Oh, this is going to be fun to watch. All right, man. Well, I appreciate your time this week. It's been great. You have a great weekend. All right.
You too. Take care.
Yep.